Well, let's get some analysis surrounding what's going on in these markets and what it means for us here at the Open. Chris Weston joining us from IG in Melbourne now. Chris, great to see you. And yeah, in terms of the moves that we've seen in markets, we thought there was a bit of recovery happening, stabilisation perhaps on Wall Street. Hasn't managed to hold that into the close. So what does that mean for us at the start of trade?
Yeah, it's not going to be a particularly, it's going to be a pretty lively but not particularly good-looking start, to be honest. I mean, despite futures were shut yesterday during the day session, they reopened for the SICOM night session at 5:10. Ultimately, they're down about 1.3% from the cash close. So I think we're going to be looking for a market that's going to be down 1.3% on open, which is quite interesting. I mean, if you look at where the S&P futures are in relation to where we closed on Friday, they're down about 2.2%. So it looks like we're going to nicely outperformed the S&P futures by about 1 percentage point. It's difficult to know what's actually going to fire and do very well today. What I think is going to be very interesting is just to continue to look at what happens in China going into these Lunar New Year. We have seen this investment trust being bailed out, so we know that investors there are going to lose the interest component of that, but they are going to receive their principal back. So that's going to be very positive indeed. It's one of the macro concerns that markets have been looking at. So hopefully we can see China doing a little bit better. I think perhaps we might see a bit of strength coming back into that renminbi as well. Let's have a look at what happens in the Nikkei, because that was down 2.5% yesterday. It looks like we're going to see that market open relatively flat, but dollar yen has moved back. One of the big concerns again on a macro level was what was happening on the yen carry trade, and when we were seeing people unwind those carry positions. That looks like that has abated a little bit. We did see a pretty terrible trade balance number coming out of Japan yesterday, but I think we are seeing that yen weakening again, which is obviously quite positive for the Japanese market and obviously global markets as well. So it's going to be a tough day for markets, I think, today. Hopefully we're going to see China look to see a bit of bargain buying as we go into the back end of the day, and maybe that can alleviate some of the fears that we've got here, because BHP's ADR, if it is accurate, is suggesting an open about 2.3% weaker today there.
Right, okay. Just in terms of how you're reading this emerging market crisis, this sort of fresh bout of selling, if you like, we were seeing Reuters talking about this being just phase one, that, you know, if the big institutions join in as well, run for cover. What's your view on that, how this plays out?
Yeah, I haven't seen the article myself, but I know there's been a huge amount of money which has been taken out of emerging, something like 50 billion or so. What's interesting now is if we look at the 10-year, which obviously is part and parcel of this whole liquidation trade, it has come off quite sharply. I mean, people are buying US Treasuries, which is good from that regard. I mean, it's come off from the beginning of the year at 305 down to about 276 now. So I think the thing with emerging markets is that a lot of the nations were really not particularly keen on QE to go ahead, and now they're basically sitting there hoping that it doesn't end. So it's kind of this ironic phase that they're going through. But this week's going to be a key week, Bridie, because we've got central banks galore coming out talking about their current situations. We've got Turkey, who are coming out with an emergency meeting tonight. Will they look to come out and raise rates? There's no way that these guys are going to be coming out and doing any kind of capital controls when they've got a 6% current account deficit. I mean, they just really can't do that. They need hot money inflows to pay that deficit or fund that deficit, should I say. We've just seen Israel coming out of their central bank meeting. They've come out and said that they're buying US dollars to support the weakness that they've seen in the shekel. There's about 5 or 6 different central bank meetings, including the South African central bank this week, and the rand's been getting absolutely smashed pillar to post. If you run a high current account deficit, if you've got falling terms of trade, if you've got any kind of political situations, think Thailand, all these kind of countries, your currency has been absolutely smashed. Argentina, 15% down in the last 5 days. So there are real risks around emerging markets. The traders are saying, is this another Thailand kind of crisis again? I don't believe it is personally, but there are risks, and that's what equities have been selling off on the back of.
Of course, this week we've got the Fed coming through. What do you think's expected? Do you think it could surprise, not taper this time?
I don't think so. There has been some talk that the Fed are going to be looking very much at global markets, looking very much at the emerging market side of things, and perhaps they're going to hold off from tapering. I mean, that's been a growing voice, and I suppose from a certain perspective you can understand why US Treasury yields have come down quite sharply over the last couple of days. It hasn't just been a pure risk-off move. Perhaps there's some fixed income traders saying they could hold off from their tapering, and therefore US Treasuries remain a very good buy at those if that was to materialise. 5 out of 77 economists on Bloomberg are calling for them to hold off on tapering. And none of the big US investment banks expect them to hold off. I personally see that they will be cognizant of the risks around emerging markets, but if they hold off for a couple of months, when the US labour situation is still relatively strong, that's not going to change anything. A couple of months is not going to change anything for them. I think they'll be cognizant of the risk around emerging markets, but at the same time, I still think that they go ahead and look to cut the pace of bond buying, $5 billion over treasuries and $5 billion over mortgage-backed securities still.
Chris, as always, great to get your analysis. Thank you so much for that.
Great. Cheers, Bridie.
Yeah.